One of the things that we look for as a starting point to try to find these places that have lift is you look at a metro area, any metro area, and what tends to happen is that within the city center, that's where the city began, right? The city center is where it all started, and then you have these concentric rings. Usually you have a beltway going around it, then maybe a second ring of highways around that, and you could see from a shot of Google Earth here in Houston, you can see just visibly where the population growth has been, right? Where the density of population is, where the development has been more dense. It's not like you're dropping a pebble into a pond and it just ripples out evenly. It ripples out, but it ripples out unevenly, right? Suburbs develop at different paces from each other. No matter where you go in the country, you'll find the parts of that MSA, that metro area suburb, that are more expensive than others, and you can sort of figure out why. I grew up in New York. New York's a city that's been around for a long time, so I've been able to see this played out over a 180-year period of time as we really study the way New York developed. But suburbs that are the same distance from Manhattan are vastly different in terms of the values and the rents of the real estate. And it has to do with the branding of those markets, Westchester County as a brand. It has to do with mass transit and transportation into the city. It has to do with the way these places were developed and when they were developed. And what it presents is an opportunity that you can look at Houston and say, where's the late bloomer, right? Where are the places that are going through changes that are going to give me that lift in the future? So we spent some time with Rich Drake, who is our franchisee down in Houston, the real estate junkie extraordinaire. And he shared some things with us. We went down, we visited, and I'm going to show you now what we learned. Most people understand that Houston is very dependent on the energy industry. Biggest chunk of its employment base is in the energy industry. Sometimes people think that when oil prices drop, which they have, and when therefore gas prices drop, and when therefore the energy industry is going to go through a contraction, that cities like Houston are in for a really tough time. Now, that has not actually happened. I've seen the Houston Chronicle predict that Houston was in for it a couple of different times over everything from energy industry contraction to hurricanes coming in. It's a very, very resilient city, but the contraction of the energy industry did cause some shifts. And so if you look at this map right here and you look directly west, you're going to see what is commonly referred to. It's known as the energy corridor. All right. Energy corridor is where a lot of the businesses and therefore a lot of the employees went west of the city. As the industry contracted and as jobs were lost, one of the things that happened was that ExxonMobil, hugest energy company in the world, heavily based in Houston, they consolidated. All right. So the headline is Houston's in trouble because of energy industry contraction. The subheadline or someplace deep in the article should have been really understanding what that meant. And what it meant was they were building a new campus. Okay. ExxonMobil back in 2015 launched a new campus up here in the Woodlands. All right. So you see this pin on the map up here. The Woodlands consolidated employees from facilities all around Houston, took employees and employment away from facilities in the energy corridor, brought it up here, but also brought people like ExxonMobil closed facilities in other parts of the country too. And so a story that was supposed to be bad for Houston ended up being very, very good for the suburbs north of Houston. This facility it holds 10,000 employees. Again, energy industry employees, so relatively high paying jobs. It's still within reach of Houston, but what you can see is that as I scroll back again, you can see the Woodlands is kind of outside that second ring. You got the first ring, then you have the second ring, and it's on the outside of the second ring. The Woodlands used to be, quote unquote, in the middle of nowhere. And part of what our pursuit nowadays is finding those places that are in the middle of nowhere now, but are about to be in the center of somewhere. All right. The sprawl is making its way out. It's expanding into those areas. And when you have an anchor like ExxonMobil having 10,000 employees, what it does is it activates places around it and even further away. So I call this a suburban two-step. Mark Fleming, chief economist from First American, who we interviewed last week on a show like this, called it the grasshopper effect. I like that too. Grasshopper effect is in Houston, the jobs are here in the center. And then all of a sudden the jobs start moving out to the suburbs, and the people that used to live, in the suburbs, now the suburbs go further out. So people are willing to commute a half hour. They go a half hour out from the center. Then the job moves a half hour out and they move a half hour further than there because you get a better deal, right? Cost of living, quality of life, more room, more space, bigger house for the money, oftentimes lower taxes. So what this grasshopper effect here did in the Woodlands is it activated Conroe, Texas. It activated Cleveland, Texas. Texas. It activated something over here called Valley Ranch. Okay, I'll touch on that in a second. So first point is we have an anchor north of the city, and that anchor is now creating a gravitational pull of population in that market. So now what's interesting about Cleveland and Conroe is that they're in Montgomery County, at least Cleveland's in Montgomery County. And big parts of this county were dry, meaning they didn't serve alcohol, right? And so one of the biggest trends about any town in America is the food trend, right? The brewery trend, the fact that these quaint downtowns that are in the middle of the Carolinas and Texas, all over the country, these quaint downtowns were turning into foodie culture downtowns, but it wasn't happening in the Northeast trajectory outside of Houston. Again, you look and you see the population density. If I start here at 12 o'clock and I go counterclockwise, population is dense. It's dense. It's dense all the way around, all the way till it touches the waterfront. Then the northeastern trajectory is more rural still. So there's your late bloomer, the northeast trajectory. So they lifted the ban on alcohol sales. Boom. All right. And so what happened immediately is that restaurants began opening. There wasn't much of a restaurant scene, as you might imagine, in a place that can't serve you wine with your dinner, right? And then, or whiskey with your burger, or beer with your wings, right? They didn't have it. And so they were missing something that was keeping population from migrating there. That's what's changed. And the combination of these two things were a bunch of employees coming up to the tip top north of the city to work, now giving them access to places like Conroe and Cleveland, where there's a quality of life and a cost of living and an upgrade in the nightlife because of the foodie life. That's as simple as it is. Those are the things that are going to give these markets lift. And so if I showed you real quick, let me just give you a quick glimpse, quick analysis I did here. Here are two charts that come off of, in this case, I grabbed them from Zillow because they got down to the granular level and helped to illustrate a point. The green line is when the Exxon campus opened back in 2015. The energy corridor, as you can see, had a good bump in property values as the economy recovered after the housing crisis. But after that, it kind of hung around. An erosion of a job base in a place like Houston is not going to kill the housing market in the energy corridor, but it didn't help it. And so that part of Houston didn't see much in the way of appreciation. That's not lift. Then you go to Cleveland and you can see that it was down, the average price was down just under $100,000 back when that facility opened up in the Woodlands. And you can see that it made its way up closer to 150. So there was actually a 61% increase in the average property value in Cleveland, Texas in the last 5 years. That's lift. That's it. This is very, very common sense. If you understand people, why they go where they go, what the reasons are why they go there, are they going to continue to go there? Is it going to attract people? The answer is yes. And now here's the sugar on top, or the icing on top. This is all happening before COVID, and now it's all accelerating, right? The big takeaway for me with the COVID experience is that a whole bunch of things that were already happening are just accelerating. They're happening faster, all right? And it's across the board. People leaving New York to go down to Florida. We're getting 10 years worth of that migration inside of 1 year. People leaving closer into the city, or people who are working in the city who are no longer going to commute to an office in that city, going out and making their way out to the exurbs. Noel has been identifying that second home markets all around the country are changing from being second home markets to being primary residence markets. I mean, he lives in Steamboat Springs, Colorado. There's no jobs there except for through his Zoom camera. But he's seeing that tipped him off, and now he's noticing everywhere that second home markets are catching on. All this stuff is happening more quickly. Amazon is eating Macy's. They were already doing that. It's just happening faster. So COVID is the great accelerator of sort of mega trends in population and demographics. And that benefits these places that are these outlying suburbs, that when you see a 61% increase in property value in Cleveland, Texas, before COVID, just because of the natural migration up that way and the things that I've talked about with the changing landscape and the Woodlands employment base, now that's all going to go faster. All right. So when I'm done in about 5 minutes, Noel's going to jump in and actually show you brand new homes that we have got listed here in Cleveland that have tenants in place. I told you when I opened up that we want this to be an actionable show. All right. So we share really fresh market intel that was gleaned from a combination of data analysis and boots on the ground research. The NSA and the CIA operative on the ground, right? If I want to self-aggrandize our team here. That then translates to small batches of brand new homes that we are being given the chance to sell. And that's important. They're small batches because this stuff is selling so fast that builders are actually reluctant to carve any out and give them to us. So they give us small packages of these things. I think we have 17 in Cleveland, Texas. I think they're going to be gone relatively quickly. In fact, since we launched this program of working with new builds, we call it RW Select. It's a selection of brand new homes for investors. We had 1,700 properties submitted to our program by builders since the end of May, and they all sold by the end of August. 1,700 houses. We didn't sell that many of them, okay? Because the builders had such a rush of activity coming into them that they were selling these houses like hotcakes to John and Jane home buyer. So that's who investors are competing with. We know that. They're rabid right now to get these houses because they want to get out of the city. And so these are short-term opportunities that we're trying to tee up for you, explain them for you. And if you're interested in pouncing on them, I'm pretty sure those 17 houses are going to be gone, whether we sold them or somebody walked into the model and bought it directly from the builder. But don't hesitate, if you like what you hear, to make contact with Noel and take action. All right. So that's the Northern Houston.
You're looking at a house here that it's worth $252,000 now. What's it going to be worth in 10 years? Just based off the home value, not even talking about the income of the property. The income of the property is even, icing on the cake, or you could say the appreciation is icing on the cake, I guess. So this is a property that cash flows $10,000 a year at a 4.4% yield. That's just your cash on cash. That's not talking about that appreciation and what you're going to get a bump. And so a lot of people talk about, well, how long do you need to own to really make it worthwhile? My opinion, and Greg may think different or the same, is that you need to at least own for 5 years. You're looking at something that after 5 years, if you start looking at your cash flow and your appreciation and your equity, it starts really getting more interesting at year 5. Year 5, you've got $11,500 in cash flow, and your equity, you're looking at a value of a house that you bought for $230,000 is worth $310,000. And that starts to mushroom out. This is not over the years, this is not let's buy now, hope the market appreciates 10% or 7% every year, which it probably won't. If you look at the trend line, it's what, Greg, 4%?
3.5 is the national average.
3.5 is the national average.
That's really noteworthy. And again, these things play out, right? So we've been doing this for more than 10 years, looking at these factors of migration patterns. I like to call it people watching, right? This all ties back to shelter over families. And if you could get a feel for what they're doing and why, and will it continue, is what this is all about. We've been able to pick winning markets very accurately over a long period of time. So we're very confident in this.
I do want to point out a couple of things really quick on this. In here is a calculator. You can play around with the numbers. We have the actual taxes based on the current purchase price of the home, based on the current tax rate. You don't know what the taxes are going to be in the future, but you can calculate them for currently. We have pretty low management and maintenance costs in here because this is a new construction home that comes with, all of them will come with a builder warranty that warranties the construction of the house, the guts of the house, and then you have warranties on all your appliances and mechanicals and all of those things. So that greatly reduces your maintenance costs, and you pretty much have zero deferred maintenance for the first 5 or more years, and then you're going to have very low upkeep of these homes. You can always have issues with tenants and things like that, and there's some great products out there that protect you for any damage that a tenant does. And so I always suggest to do your research on that, and we can talk about that another time. But you can be pretty close to worry-free in a house like this with very minimal repairs and maintenance issues for the first 3 to 5 years. We're taking these numbers are from our institutional investors and how they underwrite these homes. When you use assumptions to get financing, sometimes the banks are going to have you push a higher number to get that financing because they want to hit certain debt coverage ratios. But the actual costs of what we think it should be are here. So you're looking at a house that you're getting a return on your investment 11.4%, 4.4 cash on cash, but it cash flows $10,000 a year. Appreciate everyone coming on the call. Feel free to reach out.
Yeah, hey, thanks for being here. Hope you have a great weekend. Noel, good job, partner. Always a blast.
Thank you.
All right.
All right.
Peace.
Peace out. Thank you.